welcome back to Finally Revealed. In this episode, I want to talk about some financial payment terms. The first one I want to talk about is amortization schedule, or amortize. To amortize a loan amount, what it means is that this is the means by which you calculate what a payment will be for a given obligation. And there are three components to create this schedule. You can go online, and if you're trying to work out what a payment should be, you can go in and plug in these variables, and it will show you what the amortization schedule is. And it will start at the first payment, and it will start at, and then it will continue through to the maturity. Usually that's an expression of a period of months. So 12 months in a year, 36 month till maturity is 3 years. So it'll show you month by month what part of the payment is principal and what part of the payment is interest. So the variables that you plug in to determine what the amortization schedule will look like, and therefore what part of your payment goes to what part of the loan, are these three. As a function of the term of the payments, the amount of the interest rate, and the amount of the loan, the principal amount. Now, if it's going to be fully amortized, then we would say we are borrowing $10,000 at a 10% interest rate over 5 years. Fully amortized means that when you are finished making those payments, which for 5 years would be 60 months, when you make your last payment, you're finished. So that's a fully amortized loan. Most loans, except maybe your home mortgage, are not fully amortized. For example, they might say we will give you a three-year loan based at a 20-year amortization. Well, what that means is they're going to calculate the payments based upon a 20-year full payout, and that's how you're going to make your payments. That's what rate is going to determine the amount of your payments. However, you're only going to get that money for 3 years. So at the end of 3 years, you owe the rest of the principal that has not been repaid. So that's what amortization is. The next term is a draw or advance. This comes into play under a line of credit. Most people are familiar with a HELOC, or a home equity line of credit, or home equity loan. That is a loan that you can borrow certain amounts of money, usually by writing a check that adds on to the amount that you have to repay to the bank, but you can pay it back, borrow again, pay it back. The amount that you owe and the amount outstanding goes up and down. So when you are actually getting money out to borrow, to either write a check to a painter who's doing work on your house, or if you need some money to cover a big expense, then you would deposit it into your checking account, or you would ask the lender for an advance, and they would either give you a check or transfer it to an account. That act of getting money from them on a line of credit is an advance or a draw. The next term I want to review is a balloon payment. A balloon payment is the amount that you owe at the end of the term of a loan when the loan doesn't fully amortize. So when I was talking about amortization just a minute ago, and I said that an amortization schedule can be based upon a term longer than how you are actually going to pay this off, when that happens, it creates a balance due, and that is the balloon payment. So you need to make sure you understand that when you're going into the negotiations, because if you are getting a loan for a 3-year term, and it's going to be based upon an amortization that is a number bigger than that 3-year term, you are going to have a balloon payment. So you need to use that information to shop or find another loan to repay this, other financing, or you're going to need to be able to pay the big balance that's due. Sometimes people make these types of financial arrangements on a piece of property, maybe an investment piece of property, that they're going to sell. So they want smaller payments, and they know that they're going to have to pay the big chunk of the loan at the end, so they plan to sell that asset in order to pay that balance. The next term I want to go over is prime. They say we're borrowing this money, it's 1 point over prime, or you'll hear references to the prime interest rate, or the Wall Street Journal prime will be used in certain documents. The prime interest rate is the rate that banks are charged on their money, and they use that rate to calculate what they are going to charge you to borrow money from them. And so when they say it's the prime plus 2, it means whatever the Wall Street Journal prime interest rate is that's reported, it's published daily, plus 2%. And usually those situations are when the interest rate is going to be variable. Therefore, it's going to go up and down and fluctuate over the term of the loan. It's not going to be a fixed number. So you need to familiarize yourself with what the trends are at the time that you agree to this, so that you understand what the interest rate changes can be. And usually they'll put in a ceiling or a floor so that they keep it within a range, so that it's not terribly high or terribly low, and you can kind of gauge it that way when you go into that transaction. And that brings me to the final term in this video, which is lock-in. This is used when you are applying for a loan and there's loan approval, and you are coming to an agreement with the lender that these are going to be the terms. Traditionally, the interest rate is the biggest factor in determining who you are going to borrow money from. Then there are some other matters that come up later, but this is the most important financial part of the deal other than the term. And when you lock in an interest rate, that means this is the interest rate they are going to charge you. If the interest rate overall in the community or in that market for that type of loan goes down tomorrow, you have agreed to this interest rate. And if it goes up tomorrow, you have agreed to this interest rate. So that is what the transaction will bear as an interest rate going forward. So once you lock in, that's what you are agreeing to with that lender. They then make arrangements for the funds to come in for this loan. That's how they've priced it, which is what that lock-in interest rate means. And then you go forward and execute your documents. I hope this was helpful to you. If it was, give me a thumbs up. Subscribe to see our other videos. Leave any comments or questions that you have for me below. And come back and see me next time. Thanks for watching.